All right, let's take a look at some liabilities related to warranties. Okay, and warranties are typically considered to be a contingent liability, but we know that if we offer a warranty, unless we just make the perfect product, we're going to have some liability there. So I want to separate warranties away from the just kind of contingent liabilities in more of a legal sense, okay? Because we know that we're going to have some warranty. We're going to have some warranty issues with products that we sell. Some of those items are going to break down during the warranty period, and we're either going to have to repair, replace, refund, whatever the policy for the company is. So let's look here. Got a couple false questions. Don't see many of these, but it says here, the journal entry to record the cost of warranty repairs that were incurred during the current period but related to sales made in prior years includes a debit to warranty expense. So we need to be careful here. Make sure we understand exactly what they are talking about. They're talking about the cost of the warranty repairs. So let's say that we had some sales that we made last year in a prior year, and we estimate that there was some of those we were gonna have some returns. We're gonna have to honor some warranties. What now with this cost of warranty repairs? Is this a true or false statement? When we actually make the repairs, is that when we debit warranty expense? This is a false statement. Okay? We must recognize the expense in the period for which the corresponding revenues were earned. We call that the matching principle. So if we estimate that we're going to have, let's just say $200,000, let's just say that we have a 3-year warranty for the products that we sell in the current period. We're going to debit warranty expense for $200,000. And then we're going to set up a payable for the full amount. And then in subsequent years, whenever we actually start incurring these cost of warranty repairs, with each one of those warranties that we honor, we're going to debit this pay here. And then we're going to credit, either inventory. If we do a replacement, we might, if we do a repair, we might have some kind of supplies as our credit. If we give a refund, it would be, cash potentially. That doesn't usually happen though. So this is a false statement. Let's look at the second one that we have here. It says, during the first year of operations, a company granted warranties on its products at an estimated cost of $8,500. The product warranty expense should be recorded in the years of the expenditures to repair the products covered by the warranty payments. Well, I got news for you. This is the exact same question as the one above it. So if we had a false answer up here, we're going to be false again. This is not true. During the first year of operations, if we estimate warranties costing us $8,500, well, that's when we made the sales. That's when we record warranty expense in full for $8,500. All right, let's move right along. It says here, XCOM sells radios, and each unit carries a 2-year replacement warranty. the cost of repair defects under the warranty is estimated at 5% of the sales price. And during the month of September, the company sells 100 radios at $50 each. It says one radio is actually replaced during September. For what amount in September would XCOM debit product warranty expense? All right. So they're trying to trick you here in case you weren't paying attention for those first two true-false questions. So the first thing we have to do is determine we sold 100 times $50. Okay. And just to make sure we don't make any mistakes, get up here. Let's do this. Let's bring our calculator into play, and we're going to go 100 times 50 equals $5,000. So we made sales $5,000 for the month for these radios. However, if we look here, it says that it's estimated that about 1 in 20 of these is going to come back. So we have to multiply this 5,000 times the 0.05. And if we do that, we're going to come up with $250. That's $250. So it says here, for what amount in September should XCOM debit product warranty expense? $250. We don't actually have to make the journal entry, but if we did, we would have a debit to warranty expense for $250. We would also have a credit to warranties payable for $250. Okay, moving right along. Says here, right here, so estimating and recording product warranty expense in the period of the sale best follows the A, cost concept, B, business entity concept, C, matching concept, and D, materiality concept. We sometimes call the matching concept the matching principle, and that is going to be our answer. And I alluded to this up in those true-false questions. We record the full amount of estimated warranty expense in the period of the sale because of the matching concept, matching principle. If we recall back to our earliest days of studying accounting in our very, very first accounting class, we said that the matching principle or matching concept was the idea that expenses must be recorded in the period that the corresponding revenue was earned. So, that's why we have to record the warranty expense in the period that we made those sales. Same thing as why we record, let's say that we have an employee that works for us for a couple of weeks, let's say from the 15th, that's a biweekly payroll, and that payroll period is from the 15th of May to May 29th. But they're not going to get paid, right, until sometime in June. That doesn't matter because they helped us generate revenue by their labor back in May. So the exact same thing, exact same principle applies here. C is our answer. All right. Next multiple choice question says, the journal entry a company uses to record the estimated product warrant liability expense is, well, all we have to do is go back up here to that little example that we had, way back up here. I made up the $200,000 out of thin air. But we've got it right there. We've got a debit to warranty expense. We've got a credit to warranties payable. And I suspect that we're going to have something very similar to that in this question. So let's just see here. Now they've added a extra word here, but let's look at choice A. Debit product warranty expense. That sounds good. Credit product warranty payable, which is pretty much what we did in our example up at the top of the page. All right, last question, and we'll close this video out. It says, Wright Company sells merchandise with a 1-year warranty. This year, sales consisted of 2,000 units, okay, for the year. It is estimated that warranty repairs will average $15 per unit sold. So these must be some pretty expensive items, either that or they're complete junk. And that, and 30% of the repairs will be made this year and 70% next year, right? Because let's say that, you know, some of these, the sales that were made in January, we might have to make good on some of those in the year, but some of these sales are going to take place, you know, in November, December, or later in the year. And we might not have to honor them until, you know, 1 year from the date of sale would be in the next year. So that's what they're saying here. In this year's income statement, Wright should show warranty expense of A, 9,000, what they've done there. Let's just look at what they've done. They have, let's see, we got 2,000 units times $15. So 2,000 units times an estimated warranty expense per unit of $15 each is $30,000. So now we have to look and see if we understand what it is we're doing here. This choice A for 9,000 is based on 30%. 30% of 30,000 is 9,000. 70% of 30,000 is 21,000. But if we've been paying attention, we should know that we must recognize full warranty expense in the period in which the corresponding revenue was earned, i.e. the product was sold. Therefore, 30,000 is our answer, and that just so happens to be choice C.